India's benchmark Nifty 50 index, India 50, is close to bear market territory, having dropped over 18% since hitting a record high in mid-October 2021. June has been particularly difficult for Indian investors, having seen the Nifty 50 index post gains in only 2 sessions out of 13 on June. For new retail investors, 2022's equity sell-off represents an unprecedented macroeconomic scenario. Investors conditioned by liquidity-fueled quick rebounds seen after the crash of March 2020 have been caught off guard on buying dips in 2022 as support levels continue to break and prices keep sinking. In this video, we have put together everything you need to know about the Nifty 50 index. You will also find a Nifty 50 forecast and analysis that can help you plan your investment strategy. At the start of 2020, the world was still coming to terms with the seriousness of a once-in-a-century pandemic. By March 2020, panic selling ensued, resulting in the Nifty 50 losing nearly 40% to a then 4-year low. As central banks cut interest rates and governments released fiscal stimulus to support economies, the flush of liquidity in the market fueled a fast-paced rally in global equities. Having bottomed at 7,511 points on March 24, 2020, the Nifty 50 recovered its losses by early November 2020. The index went on to scale multiple record peaks in 2021. Each time the Nifty 50 index fell in 2021, it came out stronger as investors saw dips as an opportunity to accumulate positions. Rebounds from buy-the-dip investing were prevalent in early 2021, when the Nifty 50 saw weakness due to a second COVID-19 wave hitting India, which saw cases spike to over 300,000 a day. By October 2021, the Nifty 50 had surged to an all-time high of 18,604 points. The index had rallied over 147% from its low in March 2020. The strength of retail investors was a major factor in the index's bull run. The Wire reported that India added 14.3 million new investors in fiscal 2021. The Nifty 50 started seeing weakness as foreign institutional investors started pulling capital out of Indian markets. Data from Jefferies showed foreign investors have been net sellers of Indian equities for 9 straight months from October 2021 to June 2022. We do not believe that the FPI selling can reverse in a hurry despite strong fundamentals, as valuations are still rich, said Mahesh Nandurkar and Abhinav Sinha, equity analysts at Jefferies, in a note. According to Jefferies data on June 13, the index was trading at a 1-year forward consensus price-to-earnings ratio of 17.9, compared to an average PE of 16. The Nifty 50 index has fallen 13% year-to-date in 2022 as fears of a global recession sparked by high energy prices and tight monetary conditions continue to unnerve investors. Globally as well as domestically, equity markets saw carnage in the last couple of trading sessions as central banks across the world make aggressive rate hikes and its impact on economic growth, said Siddhartha Kemka, head of retail research at Motilal Oswal Financial Services, on June 17. Nifty almost corrected by almost 18% from its peak and is entering the bear phase. Further delay in monsoon, persistent FII selling and rising COVID cases have also dented sentiments. The Nifty 50 is India's benchmark equity market index, alongside the S&P BSE Sensex. The Nifty 50 tracks the performance of the 50 most valuable publicly listed Indian companies by market capitalization. As of May 31, 2022, financial services dominated sector weightage at 35.6%, followed by information technology, 15.9%, oil, gas and consumable fuels third, 14.3%, FMCG, 8.2%, and automobiles, 5.6%. In 2022, much of Nifty 50 index's underperformance was due to the IT sector, which has lost over 31% year-to-date, on June 17, 2022, on the back of souring investor sentiment for technology stocks globally. The Indian banking sector has dropped over 10% year-to-date, ahead of automobiles, 2.5%, and FMCG, 3.6%, on June 17. Oil to telecom conglomerate Reliance Industries was the Nifty 50's largest constituent with a weighting of about 12.5%. Private lender HDFC Bank and information technology firm Infosys followed with index weightings of 8.4% and 7.6%, respectively. High inflation is the primary concern for the investing world in 2022, prompting central banks across the world to embark on rate hike cycles.
Investors now fear that tight monetary conditions will culminate to low economic growth and recessions in many economies.
It's a key factor shaping the Nifty 50 forecast. Higher than expected U.S. inflation data from May prompted the U.S. Federal Reserve, Fed, to hike rates by 75 basis points, BPS, on June 15, a first in nearly 20 years. The Fed's hike triggered a host of central banks to hike rates in response. Most notably, the Swiss National Bank surprised markets by delivering its first rate increase in 15 years with a 50 BPS hike. Gone is the reference to the highly valued Swiss franc and the need for FX intervention to redress it. Instead, the SNB has inserted a telling phrase: to ensure appropriate monetary conditions, the SNB is also willing to be active on the FX market as necessary, said economic think tank ING in a note. The Reserve Bank of India made a similar move about a month ago by starting its rate hike cycle with a 40 BPS increase in May. Under pressure from the Fed's aggressive tightening policy and having seen the Indian rupee fall to a record low against the US dollar, the RBI followed up with a 50 BPS hike in early June. We see a faster pace of the Fed hiking cycle as a potential risk to some of the regional central banks, said BofA Securities. In particular, capital outflow concerns may aggravate, as many of the economies in Asia ex-China are net debtors in terms of net international investment position. In our view, such capital outflow concerns could be greater for Korea, Indonesia, Philippines, India, and Thailand due to net debtor positions in net portfolio investment, said BofA Securities. The bank also added that it expects the RBI to front-load policy normalization with larger than usual size hikes at the beginning of hike cycles. At home, Prasenjit Basu, chief economist at India-based ICICI Securities, sounded in a more optimistic tone. The bigger rate hikes will not hurt India's economic recovery significantly, as the three-year slump in bank lending, partly a consequence of the spike in the government's borrowing requirement, is now turning around.
Nevertheless, Basu noted a change in RBI's tone to marginally more hawkish in June.
The June 22 statement dropped the intent to remain accommodative, instead making it clear that the Monetary Policy Committee was now focused on withdrawal of accommodation to ensure that inflation remains within the target going forward, and implying that it could return to supporting growth only after headline consumer price index inflation had been reined in to less than 6% YOY, said Basu. Economic data is seen as crucial as ever in 2022 as investors look to it as a guide to anticipate central bank actions and possibly predict market bottoms. So far, India's monthly CPI data has not been encouraging, with inflation remaining well above RBI's target range of 2% to 6% in the last 4 months starting February 2022. Expectation of higher inflation remains intact, with ICICI Securities raising its CPI inflation forecast to 6.5% for fiscal 2023. Given that the Iran nuclear deal has collapsed, and the Russia-Ukraine war is no closer to ending, we are revising upward our expectations for Brent crude prices. They are likely to stay higher for longer, said Basu. Lower energy price, in turn, is crucial to the health of the Indian economy, which imports over 80% of its crude oil. To get inflation lower quickly, we ideally need the supply-side capacity of the economy to better balance with strong demand, explained James Knightley, chief international economist at ING in a note after the Fed hiked rates by 75 BPS on June 15. However, the geopolitical backdrop, COVID containment measures in Asia and the lack of worker supply in the US suggests this isn't going to happen soon. Consequently, inflation is likely to be slow and sticky on its descent, thereby putting the onus on the Fed to weaken demand via higher interest rates, he added. According to Yesha Shah, head of equity research at Samco Securities, the Nifty 50 broke its critical support level of 15,700 recently. Meanwhile, in its Nifty 50 forecast, economic data provider Trading Economics suggested that the index could reach 15747 by the end of this quarter and it fall to 14,456 in 1 year. Trading Economics did not give Nifty 50 forecast for 2025 or 2030. Elsewhere, Deepak Jasani, head of retail research at HDFC Securities, also provided key levels for the Indian benchmark index. On falls, 15,315 could give some support, failing which the Nifty could head towards 14,340 levels over the next few days or weeks. Rate hike fears have depressed expected valuations of stocks on the one hand, while making debt instruments attractive. note that Nifty 50 predictions can be wrong, and forecasts should not be used as a substitute for your own research. Always conduct your own due diligence before trading, and never invest or trade money you cannot afford to lose.